All right, the market's following a very familiar pattern of pretty much not going anywhere. So very small range. The VIX is dropping, the average range is dropping, the volumes are dropping. It seems like the market is kind of in a waiting pattern for something to come up. And what do we have coming up? Well, the next 2 weeks we have an insanely large boatload of earnings announcements, as well as the FOMC next week. The market's probably going to get some volatility. We've been lacking the volatility for a couple of weeks. The market's probably going to get some. So let's take a look. We'll take a look at some patterns to see, whether or not we have pulled back enough, or at least gone sideways enough that we provided a good launching point for us, or not, or if we're still just in convergence mode in that resistance with a significant ceiling above us. So we'll break all that down in today's video, as well as take a look at what's driving this action today. A couple of kind of outlier moves. We'll talk about what they were and what they mean, and then our trade idea is a trade that we've been doing. It's a pretty common strategy we've been using lately, and we'll use it again and show you the type of stock and chart to use it on. And again, our goal is to get to a YouTube 10,000. That's our goal for the next so many months. So if you haven't subscribed to our YouTube channel yet, let's subscribe to there and let anybody else know. And let's see if we can get to that 10,000 mark. With that said, let's go ahead and get started. Today is Monday, April the 24th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things on the right, including our Market Outlook live video I do at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up a new tab like this, and you can click that thumbs up icon or that like button that pops up. Also click on this thumbs up icon. It opens up another new tab. Hit that like button as well. Again, the more you do that, it really helps us get our content out to all of our followers. That's why we always ask. We almost got back up to 100, so if we can, that's our magic number that we shoot for every day. So thank you all to those that like these videos day in and day out. For those who don't, let's try to get to that 100 mark, and you can do it right now with one or two really easy clicks while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the little bit of a bump higher we had today, slightly higher high, slightly higher low. You'll see that here in a second. It was a higher close. It brought both the momentum and the near-term line higher. The near-term line dipped its toe in the bearish territory on Friday before expiration, has now come back out of it. Now it's not necessarily in bullish territory, and it's not like the momentum line spiked, right? Ideally, you want that momentum line to spike, and then that will bring the near-term line up, and you can stay there, right? You get enough kind of a thrust that you can keep the bullish momentum once you start it, kind of like an ignition. When it just kind of grinds, and it just grinds like we've been seeing for the last little bit. We never really had the big move to get us going. I've been mentioning how we've been lacking the 2% rally that starts the bullish move. Well, we've been lacking, really any kind of move. Most outside of, one barely there, and then there. 3 days in the past few weeks, we've even been out of a 0.5% range. So we've had three rallies of 1% or more before the last. Since the last 1% decline. So really just haven't had very much of a move, very much volatility whatsoever. That's why your market sentiment line is about as flat as a pancake. It's kind of fluctuating up and down right in the middle of the chart below the below bullish territory. But not in bearish territory either. So that's at least a positive. You can see we are just a 2.25% above the moving average, so not like we're taking off here. But again, at least we have dark green shading and a green line. So there is some element of bullishness there. Same thing with the Dow Jones. Same thing, bounced up higher. Intermediate line still strongly bullish, but we're only 2.5%. And market sentiment is rising in neutral territory. If you look at the NASDAQ 100, which has been a little bit more bearish here, we've been really neutral to the point of we're actually kind of biased to the downside a little. The near-term line, momentum line also rally, but they're still closer to bearish territory than they are bullish. The momentum line actually still is in bearish territory, and you're only 1% above the 30-day moving average. Finally, your Russell 2000, which has been the trying to pick up here, had been the most bearish during the financial crisis that we had. We finally have dark green shading. We've got the bear tag. We finally have dark green shading in the green line. So the intermediate line is crossed above 50. We are above a rising moving average by just a measly percent. I mean, so that's about as weak of a bullish signal as you could possibly get, but it is a bullish signal. We are crossed above the market sentiment line. The near-term line is crossing back above intermediate. So there is a bullish signal developing here. You just, when you get these bear tags, we've had 3 now. The latest one on Friday, like to really break through. We like to really grab it and hold and get going, at least for the next couple of days, really solidify the break above the moving average. And obviously that's just not the case right now. Looking at the weekly chart for the S&P 500, you can see this week is a transition week as of right now, right? We did get a slightly higher high. We easily got a higher close last week, so it's a bullish candle. Wasn't very big of a bullish candle, so the size of the candle, size of the body, which is what the Hakunashi differential measures down here, is declining still, and it's obviously even smaller now. It's still bullish, so we're still above zero, but we are below the moving average, which tends to lead to a reversal, and this would be the transition week. Obviously, we're getting a lower high, but what's even more important is the lower close. That leads to a transition type week. If it ends up being a bearish week, right, a real bearish week, then you have good odds that will be, reversal. Otherwise, if it ends up being, if the regular candle ends up being kind of flat like this, then we're probably likely to get another flat candle the week after that. So more transition. So we'll kind of keep our eyes peeled for the rest of the week and see how this develops. If we get really bullish this week and kind of break out here, we kind of need to, if we're going to get a bullish candle and really kind of continue the streak and get this green line back above, then you do have to break through resistance. And so we're kind of at a, kind of fish or cut bait moment for the market. Either you're going to break resistance or, we're not. We're going to transition to a reversal, even if it's a light one, but we're going to transition to a reversal. And as of right now, it appears the latter is winning out rather than the former there. When you take a look at the 3 green arrows charts, we do have we had 3 green arrows on Friday. We're back to a red arrow on the stochastics. We're close to a red arrow on the MACD. All the other MACDs have red arrows, so there's not a single 3 green arrow signal yet. But, at least we don't have the 3 red arrows, right? Which you need to get below the moving average usually to get the 3rd red arrow. And the S&P and the diamonds are nowhere near it. The Nasdaq's a bit closer, and of course the Russell is the closest. But that's kind of what we need to see to get pink shading, and then again, remember, multiple days of pink shading if we're going to be bearish for an intermediate decline like we had during that 3-month move there. Looking at the 2-line version of the 3 green arrow chart, again, you can see we are still in convergence mode. The MACD is below its moving average. It's still above 0, however, and we're still above the 17. In fact, we're above the 8-day moving average on Friday and today. We are at this volume node. We're at the value area. We've got multiple layers of Fibonacci resistance here. So, we are moving into significant resistance with a convergence mode, which is ideally not the case. But, maybe if we just get a little bit of a near-term pullback down to maybe the 30-day moving average and bounce off of that, now we might have a little bit better of a move. We can break out of this resistance with a divergence move where the MACD is above its moving average, rather than just grinding below it here. Of course, remember the Qs have been the most bearish. We've been converging for a while, and it's the one that's probably closest to flirting with that 17-day moving average. When we take a look at some of the other oscillators, like the DMI for the S&P, both lines are now both below 25. So according to this, there's no trend going here. The negative indicator is below 20, so at least you're biased a little bit to the bullish side. But with both of them below 25, that kind of matches what you see here. It's a weak, very, very weak trend. It's flirting with intermediate trend strength, but again, the longer we go, the more likely we are to break back down below 50 and 0, rather than reverse to the upside. The RSI and the CCI are also kind of at neutral levels. The MACD, the RSI is a little bit above 60, so it's hanging in there on that bullish move. We could probably turn this green again after with this move back above 50 and getting above 60 there. So it's kind of a short red. We could probably do a little short red here, and then move that one green. Let me do that here really quick. There we go. So you can see we're kind of in bullish territory here, but it was a pretty, it wasn't very long of a bullish run, and as of right now, it's not, or bearish run, excuse me. And as of right now, it's not very long of a bullish run, but at least we're still in bullish territory. You have to cross below 50, you have to cross below 0 down here, and obviously that hasn't happened yet. And then obviously you have to solidify that move with a break below 150 or a break below or a break below 40 to really change the momentum, like you eventually saw here in March during that financial crisis, which kind of solidified this as its own bearish run. So some of these other moves, you can see we got above 70 over here, barely got above 150 on that fake out move all the way at the very end of that particular bullish run. Let's take a look at the Bollinger Bands and the Keltner channels, which you can see the bandwidth is falling. Not surprising because we're so sideways, and the bandwidth is still outside the Keltner channels, but your momentum line is also declining. So in your Bollinger bandwidth's actually near its 150-day range already. We're still in that, we're not in the upper quartile. So we're not bearish, but we're also obviously not bullish anymore. And we're kind of grinding in our bullishness. We're below the average of the 4-week range, but not by a lot, but we're below the average of the 4-week range. And the hull, of course, has turned lower, and we're below the hull, and it's red, and the parabolic SARs are flipped up. So we haven't broken down below the 2.5% mark in terms of how big the candle is, but we're not breaking above the 2.5% mark either. If you take a look at today's range, look at this inside. It's not necessarily an inside day from Fridays, but it's pretty much an inside day from last week, and has been. And you can see, look at how small the range is over the last 4 weeks. It's gone down to one of its lowest levels. It's approaching that 5% mark, which is a boundary when you're bearish. When you're bullish, it's not really. It's actually not common. It's actually pretty common for it to get below 5%. When you're kind of in a mature bullish trend. But we are hitting 5% now. That has in the past been a relatively bearish level. And it's just going to get worse because tomorrow the low point's going to move up here, which is actually what that's reflecting. You can see the red line's moved up. So that it's actually reflecting this red line moving up there. But by Wednesday or by Thursday, so tomorrow, Wednesday, by Thursday, you can see it's going to move up even more. By Friday, it's going to move up even more. And then by the next Monday, none of these gaps are going to be in the 4-week range anymore. And you'll have that much of a range, assuming we don't get a new high either. We'll have to see, right? But by the end of the week, but that will be the range by the end of the week. We'll just move in, fill in all these gaps by them falling out of the 4-week pattern, and we'll be that sideways over that amount of time. That's why you're going to really drop below that 5% mark by the end of this week, unless we get a significant new high point, which obviously is not happening yet. And you can see that because we haven't got a new high point for quite a while, your green line is actually almost below 70. So we're set up for a reversal, breakout move to the downside. If not by the end of this week, if we stay flat, if we don't get a breakout to where we get a new 100, a new 100 print here, by the end of the week, then next week we are very much set up for a breakdown to the downside. Of course, considering the earnings involved this week, you would expect it's probably going to get a move in either direction. And I think we're all kind of hoping it would be a move up to the upside there. If you take a look at the volatility index today, which has been kind of doing its own thing, but still there below 17, it's still below 85%, kind of in that 82.5% mark. And you still have a significant negative correlation with the VVIX, which, as I've tweeted out over the weekend, typically leads to bullish moves on volatility almost every time. This one right here in the mid-August peak, this one here at the beginning of the year, that ultimately led to the bullishness and volatility from the financial crisis, and I mean, there are multiple other examples in the past couple of years. So it's not common for the correlation to be this negative between those two. It's generally very positive, and when it is this negative, it generally leads to an increase in volatility, which wouldn't be surprising considering what we have on the calendar over these next couple of weeks, right? Big earnings over the next 2 weeks, with the FOMC due out next Wednesday as well. So a lot on the plate that can create some volatility for the equity markets. Looking at the volume and the trading ranges, it's not surprising to see how small the trading range was. Again, 2.5 points, 64 million shares. I mean, this is doing a number on the averages. The average ATR now is plummeting, right? The ATR is down to 4.32. That's just barely over 1%, 1.05%. And it's just plummeting, and the volume is plummeting. I mean, that's already 52-week lows. The volume is also plummeting to 52-week lows. That's not very typical of bear markets, but that's the situation we're in, right? Even though we're still mired in a correction that we're trying to bounce out of, but the gravitational pull is still keeping us in the atmosphere, so to speak. But at least we're not falling back down the earth yet, and we're kind of stuck, in this trying to break out of that strong gravitational pull. That 4,000 has been, and 3,800 on the low point. 4,000 kind of still got the hold on everybody, as we can't quite get away from that mark. You can see that's kind of where the point of control is sitting right around 396. So of course, when you're in the value area, the point of control acts as pretty significant gravitational pull until you can break out of the value area and then escape the atmosphere, so to speak. All right, now let's take a look at what's driving this price action here. So let me zoom in. You can see this is the 3-month time frame, of course, but let's just zoom in on today alone. And you can see bonds are up and commodities are up, and that's not necessarily the two things that go hand in hand. Especially here lately with this past year or so, commodities have rallied and yields have rallied, right? This idea of inflation expectations does not push bonds up to the upside. Gold is up because the dollar was down today. Again, the dollar and yields are both down, and that generally means commodities are down, but that's not the case, right? Commodities are actually higher here right now, and if gold is, and high yield bonds are rising above equities. The developed markets continuing to outpace international, outpacing U.S. equities. And then you can see real estate, the Qs were down quite a bit in IWM. They rallied to a small loss by the end of the session here. Let's take a look at some of these charts. TLT, you can see how we closed on Friday, bouncing back up above the 17-day moving average, no less. The MACD is still below its moving average, but the histogram is rising pretty sharply. So you're getting a little bit of a bounce up, which is good for yields. Yields have been so bullish after breaking to that 3.25% mark. We had rallied all the way back up to a high of 3.64%. It's kind of Fibonacci level before falling back down, also back below its moving average. You can see the dollar, the big drop it had today is coming after a little bit of a rally it's had for the past week, back below the 8-day moving average. So the trend is obviously still bearish on the dollar, and that's definitely been bullish. Again, one of the reasons why international equity, especially developed markets, are doing so well. That's also one of the reasons why the S&P has been holding up so well, is because of the weakness in the dollar. Since that mid-October low point in the S&P, it's when the dollar peaked, and you can see the mid-October low point is also about where it was a little bit later, but that's where bonds bottomed. They've been rallying ever since, but rallying back up off of an oversold condition. If they're going to break through, we've talked about it before. If it's going to break through here, it's going to be because the risk appetite's falling, not rising. So I think you get to a point where bonds can rally along with equities, but there's going to be a deflationary period, where bonds will rally and equities won't. Right? And of course, that's all dependent upon the Fed and their expectations. The odds right now of a rate hike in May. Let's just refresh this page here. I think I refreshed it a little bit earlier, but we'll do it again. It's up to 95% odds for a rate hike in May coming up. The odds for another one in June dipped. This was actually at 25% earlier today. It dipped back down to 14%. So this one's pretty volatile. And so the Fed is pretty much saying there's going to be a rate hike, one more to 5.25. But then by the end of the year, the odds of us being at 5.25 are 2%. So by the end of the year, the markets are saying, the futures market are saying that the Fed will cut rates by the end of the year. And you can of course see that in the 2-year yield dropping back down to 4.1%. You can see that as well. The 3-month, of course, is more of an effective rate, so the 3-month is going to match kind of where rate hikes are going right now. So it's still above 5%, big gap there. And then you still got about 150 basis point spread between the 10-year and the 3-month, which is just so abnormally high, but it's gotten even higher, down to 157 basis points. The spread between the 2-year and the 2-year and the 10-year, which had been pretty low itself, is kind of still stagnating here, well off of its lows of a full 100 basis points. But not getting back above and staying above the 50 basis point mark. We're kind of stuck in the middle between 50 and 75 basis points here. But remember, a rising yield spread eventually catches up to the markets. That's when we know that we are closer to this is a leading indicator being inverted. When it's rising, that's when you are in your bear market mode. Because again, something's got to give. Either you have strong inflation expectations without the Fed raising rates that the 10-year takes off, or where the Fed doesn't feel like it can raise rates. Usually that means kind of like an inflation shock, or it takes off with the Fed, which is more likely the Fed cutting rates. And again, the Fed itself has said they're not going to do that unless they absolutely have to, because their goal is to get the real Fed funds rate up to a positive level. They've made mistakes in the past of stopping their rate hike campaigns before the real Fed funds rate's gone positive. Mid-70s is a glaring example, mid to late 70s. So they've highlighted that example and mentioned they don't want to make that policy error again. They've done it here recently in 2018 and 19, where they started to cut rates as soon as they got the real Fed funds rate just barely positive. So they're getting closer to positive levels. We are at just barely minus 0.33, so we're getting much, much closer. But as I've mentioned before, that might be right now as close as we get, because you can see the CPI for this next release that's going to be due after the FOMC meeting, but pretty much the main one before the next FOMC meeting is actually expected to move the CPI back up to 5.17%, right in line with the midpoint of where the next rate hike will be. So you're going to be sitting pretty much right at zero on a real Fed funds rate, despite all those rate hikes that we've been getting over the past year plus. Really, just barely more than a year, because we started last March. All right, now let's take a look at the sector moves. And remember, we have some pretty strong sector movement in the S&P 500. Obviously, the Russell 2000 is a little different story, but we have dark green shading and green line pretty much now across the board. Industrials and financials, a little bit more correlated with the Russell 2000, materials, they're all turning up now. So we have now, and real estate too, just barely, but real estate has also got a green line finally. So we have dark green shading and a green line on every single sector in the S&P 500. We haven't been able to say that for a long time, but that's the case right now. So that kind of goes to show the type of market environment that we're in. When you look at these charts on a comparison chart over the same time frame for 3 months, you can see the QQQ names are up here at about 5% to 10% gains over the 3 months, with staples and utilities kind of creeping up there too, some safe havens, and these cyclical areas lagging behind. Let's just take a look at just today alone. And you can see here today, it was an energy story. That was really the only outlier. Materials also up there. Remember, the dollar was down, so that pushes these are dollar sensitive areas. Utility, staples, healthcare also outperforming. Safe haven areas, not necessarily the most bullish. Industrials joining the party. And then you can see technology, discretionary services, discretionary communication services, all lagging along with financials. Again, heading into really, really important earnings week for these cyclical areas, from industrials, so a lot this week, a lot of mega caps this week and next week. So these will be in focus for sure, both these cyclical areas for the next couple of weeks. And again, this is how bullish we are heading into this earnings announcement. The fact that, again, all 12 charts are showing the same dark green shading, the green line to some degree, right? And in various degrees on the returns. Real estate's negative, financials are negative, materials are negative, and energy is negative. But then you have, discrete communication services over here, 7%, 9.5% XOK, 4.5%. So we have some gains to go along with these kind of stronger declines that we've seen over the last little bit. All right, finally, let's take a look at our trade idea of the day. And I want to take a look at eBay. eBay's been following a similar pattern as most of the market. We've been grinding. It's been bearish, right? It got caught up in the weakness in early March, but it has since consolidated and now is kind of flat and sideways. And you got a little tiny bit of a dark green shading and a green line developing as the intermediate line is well above 60. But we're finally above a rising moving average that's turned up slightly. Not very high, only 1.73%. But at least, again, at least we're not bearish anymore. So this idea of we're not that bullish, but at least we're not bearish anymore, it's a very common situation, and it's a good situation for the type of trade we'll do here on eBay. If you take a look at the weekly chart, you can see that we've got, we've had some bearish candles, and then we're just flat. Like, look how small the candles are, just going sideways here on the PPO and going sideways on the Heikin-Ashi differential. When you're looking at the 3 green arrow chart for eBay, all these lines are all converging on each other. In fact, today's range, you had almost every line except the 50-day moving average sliced through today's range. That goes to show just how much we've converged, and we're converging right on the point of control for the whole year, right smack dab in the middle of the value area, which is the 70% of this year's volume, with pretty much one big volume node. And we're centered right on this tremendous, like I mentioned earlier, gravitational pull that we have. Both of its directional movement index lines are below 25, above 20, so your ADX is dropping to really, really low levels. So the lack of trend strength is also showing up here. You're below the cloud, so we're not bullish, but we're above these lines, and the rate of change is positive, so we're not bearish. You've got 0 level on the trend quality. You're pretty much at 0 on the noise balance as well. So essentially no trend whatsoever. The RSI and the CCI are smack dab in the middle of their charts. And then when you look at the Bollinger Bands and the Keltner channels, the bandwidth is extremely low. And you can see the point of control there acting as a safe haven. Both the Bollinger Bands have converged so much on each other that they're way inside the Keltner channels. We've got we had some bullish momentum that's been waning now into these red dots. So not a very big move, and that sets us up for an iron condor spread, which we've been doing a lot of lately, where we sell basically sell the 49.31 put spread for May. So selling the 49 put, selling the 47.49 call spread on top of it. So selling the 47 call. You can see that trade went through during our Market Outlook Live session. Again, not necessarily position sizing fully because I don't have to get a normal return. There's some premium built into this credit because of the earnings situation that's coming up. So a little bit more credit than normal, a little less risk than what we normally put. And you can see it puts our break-evens in a nice little spot here. When you look at it on this chart, for an example, those break-even lines are well outside the range of the last 1, 2, 3, 4, 5, maybe up to 6, but pretty much the last 5 expiration cycles, plus or minus a little bit, right? But the last 5 cycles and even a few before that earlier this year. So a pretty, again, a pretty good range, centered with the point of control right smack dab in the middle, exactly with the one volume node right smack dab in the middle, exactly the kind of chart that you like to trade these types of do you like to use this strategy on? We've been doing a lot of these, but again, that's the kind of market environment we just happen to be in right now. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us at marketscholars.com for free. Follow us and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.